Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawatic, sitting here with Aaron Cameron at day 2 of the Toronto Real Estate Forum. This is our first recording of the day, and it is noted that the crowd is slowly trickling in, not storming the gates like they were yesterday. Maybe an indication of all the events that happened last night.
I can note that you kind of get a sense of how long Adam and I have been doing this. This is, whatever year at the Real Estate Forum. We're certainly more bright-eyed and bushy-tailed this Thursday morning than others in the past. I think that's just an indication of our age and tenure.
We are, of course, here today doing our speaker video series. We want to thank our sponsors for that, Dow Vukovic, ML Emporio Properties, and Turner and Townsend. Kicking off day 2, we have Ugo Bizzari, CEO, Hazelview Investments. Welcome to the podcast.
Thank you. How are you?
So we would set the stage. I mean, everybody's got visibility on Hazelview. If you're in this industry, they know the name, they know you. But if we can do the intro to how you got into real estate, how you got to where you are today, just to maybe fill in the gaps for some of the people that don't have the whole story.
Well, yeah, I graduated from Ivy and I got into real estate because I got a job at Ontario Teachers Pension Fund and they put me in the real estate department. And from there, I really enjoyed it and stayed in real estate. But
like they decided for you, you'd be a real estate person?
Yeah, okay. Basically. And then I liked it. So I stayed into it. I just really liked investments as coming out of school from Ivy. But and real estate was a niche that I really liked. And back in 2000, we started a company that we felt that there was an opportunity in multifamily apartments. It was fragmented. It was an easy market to get into, and it was not being serviced by institutional capital. And so we launched a company to do value-add multifamily and launched a property management business and grew it over time. So now we're fast forward in 2023. Hazelview is, we do direct real estate, both development, value add, different asset classes, multifamily, industrial. We dabble a little bit in office and retail, but we do a lot of development. We have a huge multifamily development pipeline of almost, 20,000 units at different stages. And we do private lending and we do public security, so buy and sell stocks on the public markets on a worldwide basis. So it's grown over time. And that's the quick version.
When did apartments turn to be institutional? I mean, I would suggest you are an institution, investing in real estate in apartments.
But go back to 2000 and talk about the environment then.
Well, I think in 2000, apartments were for a long time under rent control. So institutions didn't see that, and rent control got lifted not complete rent control, but the vacancy decontrol. Mm. And there was an opportunity to go out and renovate apartments. There was basically a 40-year gap of not building a new apartment building. And there was most apartment sectors, most institutions were focused on regional centers and retail and office, and apartments were put on the side. So mostly families owned apartment buildings, and there was an opportunity to aggregate on apartment blocks and slowly build, and other people saw that opportunity. As we did, and the average deal size also was very small back then. So, at Teachers, my average deal size was $75 million of equity. I couldn't bring anything before that. So a $75 million apartment deal back in 2000 was probably a massive deal. So there was an opportunity. It's still about 85% fragmented in non-institutional hands today. And that was the opportunity.
Just for fun, what was the sort of general cap rates and value per suite?
Oh, back then, per suite were probably 60 to 70,000. Average cap was probably eight and a quarter.
The good old days, eh?
But your interest rates were 7.5, 7.25. So it's a little bit different. It's a little bit different.
Were you using CMHC back then too?
Yeah, we did,
but not as much.
No, we were using CMHC for sure. But it was just a different rate. Like bonds were a lot higher, spreads were probably the same, but your average, 10-year loan would be 7.5% back then, and your average cap would be 8.5, 8.25. So it'd be different, right? So
let's hold on to that 75-cent spread and talk about what it looks like today.
It hasn't changed much. They've both gone down.
Yeah, we'll get there.
Trends. So.
What would prompt sales back then? When you're trying to build your book, what would be the opportunities? How would they come up?
I think it's the same opportunities that there exist today, Brad. It's really a lot of it estate planning. People that have owned the assets for a long time, and families that want to get off their positions.
The kids don't want to take care of
the
toilets.
kids don't want. Like, the kids are doctors and lawyers and accountants, and they really don't want to deal with the buildings that their parents or grandparents built and hold them as legacy, and it's eventually transitioned. And so it was an opportunity to do that, and that opportunity still exists today. Like even today, most of the trades that are happening because a little bit more institutional trades sometimes, but it's more because of estate planning and frankly divorce too. So
Yeah.
those are the things.
What's the book like right now?
The book in the sense of how
size and scope.
Yeah, our size is about 26,000 units
Across Canada?
Across Canada. I think fundamentally in multifamily is probably the best it's been in 23 years. Our vacancy is 1.5%. NOI cash flows are very, very strong. Frankly, it's more of a question of, we need more apartments. We need more supply. And affordability. There is an affordability issue.
Yeah, we'll get there.
But fundamentally, multifamily sector right now is probably the best it's been in 25 years.
Durability and stability of cash flow, if that's what you're looking for, you can't beat this. Right?
Can't beat it, right?
So, I mean, it's almost gotten to the point. I mean, we're apartment lenders, so we totally have this conversation all day, every day. It's almost gotten to the point where it's gotten bad because it's almost difficult to talk about. Yeah, rent appreciation is 20% per year, and people look at you going like, that's amazing for you if you're benefiting from it as the owner. Yeah, but the reality is that's not great for society as a whole.
No, I think as a good landlord or a good property owner, you have to be disciplined not to increase rents too much. So
you have an obligation to the general good of Canadians.
Yeah, I believe that. So
I'll do a plug for the institutional owners because they think about headline risk, whereas one-offs maybe don't always because.
And most of the headlines, I would say institutional owners are really good owners. They think about headline lists and they look at the greater good. Sometimes you see in the newspapers it's where the individual one-off owner that affects the market, and that's the headline risk, right?
Thank you for using the word owner. I've said this many times on the podcast before, but if we just get rid of the word landlord,
I know.
That'll change a lot of just the context.
I have noticed I've been saying that's why it's property owner.
And the connotation is just negative, right? You're the lord of the land, and so of course you're bad, right? So
of course you're bad. Yeah.
Right? So
it's
housing
a terrible
partner,
word.
housing partners, something like that would make more sense.
But I think that housing partner is a better word. And a housing partner with, I think there has to be collaboration between government, cities, in order to fix the supply. But it's not, the supply issue is not going to be done in 2 years, right? It's a 20-year fix. So you can't fix a 40-year problem.
You mean we're not going to build 3.5 million by 2030?
No. It's going to be tough.
We're going to try. I think it's the effort. We're going to do everything we can.
We probably need 60 to 70,000 units a year today. And I think their peak construction was 35,000. So
wow. I think the number is more like 150,000 a year, which is.
Well, I'm just talking about apartments.
Fair. Are you building?
Yeah, we are building. We are in the ground on a few projects. We have 4 live projects that we're in the ground from Halifax to Toronto to out west.
Great.
We're very active in building.
Are you going to break ground on anything in 2024? Are you going to keep the pipeline going? Or
we're going to try to break ground on 2024, keep on a couple more sites. But it's not easy math.
Yeah.
Right?
That's why
rents are tough. It's not easy math. So I think you need some more, the GST and HST will help, but it's not the silver bullet. We need more trades. We need more stability in pricing on construction cost in order to really spur development. And we need the government to be more involved. So
if you're sitting there today, so you've got the math in front of you, these numbers, and rates are down 60 basis points in the last, 4 or 5 weeks. This is the question, right? So it's November 30th, just to timestamp it. You're not coming to term. You're not taking advantage of rates for another 2.5 years. So what impact? Do you just kind of ignore where rates are today? How do you? Because that terminal rate or that exit rate is material to
Are
a
you,
certain
are you
degree.
talking about
right?
your exit cap rate?
Yeah, because that matters on what
Yeah.
on your exit cap rate. It matters on what your exit loan amount is going to be. So how much capital you got to put on the development. Like it has material impact, but
It does.
If you own forever, there's no
does-
exit.
you don't take advantage of it for 2 years. So it
Well,
really is not material. You know, it's a weird quagmire.
Look, if you're in the midst of like building and trading, it has a material impact for sure. But I think if our philosophy is that we're building core cash flow, so we're looking at what we're building for our development yield, what we think we can long-term finance at, and what our cash yields are over the next 10 to 15 years are. So we're more focused on that return versus an RR return, because no one knows what the exit cap rate is, right? No one knows where bonds will be, but I think we're pretty good comfort of what we can develop at and what our cash flow is. If you pick the right location, the building will probably be full. There's a lot of demand, and you put long-term financing at a fixed rate. It's a good, steady, cash flow generation for investors. And that's where we're more focused on than exit cap rate.
If you were to rank the headwinds for development right now, where would finance risk fall in the top 3 category?
Probably at the 3.
Okay, so I noticed you didn't really mention it the first time around. I was like, that's amazing, because people seem to be giving us a lot of grief about this. So it's
No, look, I think financing is always part of it. You want good financing, but I don't think whether you're in the ground on something is because of financing. I think people are worried about where rents are going to go, what kind of rents you need in order to make the development work, and the affordability of those rents. And the other one is big trades, construction costs, right? So, you have more risk that in 2 or 3 years construction costs will go up substantially versus rates going up, right?
Yeah.
So it's a little bit different. Now if we were in 2021, it would be a different story, right? Because I put financing risk probably at the higher, because you're at the low point. You probably over the life of that development, rates are going to go up. Now you're probably at the high point, and through the life of the development, rates will probably go down, right? So I don't think it's as risky as it was.
How much time do you spend worrying about regulation risk?
A fair bit. Yeah, like regulation is an issue. Rent controls are, you put rent controls, they will really kill supply. But I think this is the first time in a long time where governments from the federals, provincials, cities are not talking much about rent controls anymore. They all recognize in order to fix this affordability crisis is supply, and that there has to be cooperation between all levels of government. And talking about supply is sort of put that back burner of rent controls on. And I think even the liberals and the feds and everyone recognize that supply is the solution, and how do we get more supply. So now it might come back in a few years, but today that political risk on rent controls is a little bit less, we feel.
Yeah, I mean, the challenge is, of course, politics is an endless cycle, and the supply will come. It will control rents, or will have an impact on rents. It just might take a decade, right? That's the challenge.
Yeah, like it's really hard to fix 40 years of no build in a 5-year cycle. And the last 3 years have been extraordinary, right? Like, we've had a pandemic, we've had the highest rate increase in rates, and things have changed, right? So, and we're letting in a lot of immigration. We're all for immigration, but we need solutions to make sure those new immigrants are coming into Canada that have places to live. And it's just not just housing, but it's infrastructure, it's hospitals, it's everything. So it's something that we should all, as Canadians, be thinking about.
So I want to ask you about the current turmoil relative to your entire career, because Aaron and I kind of joke about the silver lining of the last couple of years is given us lots to talk about in the podcast, because when we launched in 2016, 17, 18, things weren't changing that quickly. So you kind of run out of topics, but that has not been an issue.
Ooh, cap rates are down a quarter basis point on retail. Let's talk about that for 3 weeks.
So there's always a new risk, a new concern, a problem arises, problem gets solved. So over the time that you've been at this, is this the most turbulent period, or is this just the recency effect of the way we experience it?
I would say this is not the most turbulent. This is a turbulent period, but it's not what I started my career in 1990s. Okay, if you want to talk about real estate and being in trouble, 1990s were not great markets.
So if you had to
right?
if you had to rank the survive to 95 versus survive to 25, obviously that was a lot more survival mode.
Yeah, so like it's sort of funny, if you talk to sort of, I hate to say this, but an older generation, and I put myself in that older generation now. Yeah, today is, there is turmoil in the market, but it's nothing compared to 1990. If you talk to the younger generation, this is big turmoil compared to what they've
Is that just
experienced.
because that was liquidity prices? There's still so much capital floating around.
No, I think in 1990 it was a real estate crisis. Cash flows were going down. You were doing net zero rents, right? And you didn't have capital. You had a lot more leverage on your assets, and it wasn't an institutionally owned market. It was a private lender market, where Bramley would be 90% levered, right? So rate hikes of this would have cratered the whole market back in 1990. Today, it's mostly institutional. Real estate's still doing, like, the fundamentals in real estate, cash flow, especially in certain asset classes. And let's take office out of the question, but retail, industrial, multifamily, they're still doing very, very well. This is more of a liquidity and more of a pause because of what's going on in the rest of the world versus necessarily real estate crisis. Fundamentals are, as you guys see all the time, are not bad. But liquidity is an issue today. So
Yeah, I think the big challenge is we've had whatever it is, 18 years of just rainbows and unicorns, and all of a sudden there's some challenges. Cap rates don't just go down in perpetuity, and I think that is the shock value that we were experiencing.
yeah, cap rates don't go down. Nothing always goes down, and there's a reset a little bit, but also this too will pass, right? So things go up and down. Like it's any cycle market, right? Like we had one in 2009, but that lasted 6 months. So
It was more like a pause
and this is lasting a little bit longer, but this will come around too. Like even as you listen to Dave Rosenberg, rates are probably going to come down again. So the question is, we feel that 2024 is one of those vintage years for buying, and it's an ability that will reflect in 10 years, going, why didn't you buy more in 2024?
I like that. Buy more in 24. There you go.
Yeah, it's a good line.
We're an industry of slogans.
You should. That's the line you should use. But capital is tough.
If you're growing, you talked about buying, to grow your portfolio, how much of that is development, build new units versus acquiring units?
It's probably about 50-50 right now. Development is, but nothing is easy. Like buying is tough. As you guys know, CMHC takes a little longer these days.
Coming back. We can talk about that after. Yeah.
But, buying is tough and development is tough. It takes well-discipline and there's no unlimited capital. So on the buying side, you have to be very, very selective of what we're buying and making sure that we're doing it. And I think people are worried about, the stability of the market, stability of the bonds in order to start buying more. So
when did you last do when did you do your last capital raise?
we're always raising capital.
Oh, yeah, okay.
We're always looking for it. We raised a bunch of capital this year.
How's that going?
Yeah,
We've been hearing that market's real
it's
tough right now.
Scott McPherson on yesterday talked about that quite extensively. That
I bet he did.
Challenges in the market.
Look, it's not easy. It's tougher today, but it's not impossible.
Like the numbers pencil out in the current equity raise environment.
Well, look, I don't know what pencil out means on raising capital. If you have to, it's really crucial to have the right long-term capital partner and the right long-term investor with you, right? So you can't have an investor that goes in and out. People, generally speaking, redeem at the wrong times. This will be a time that you probably shouldn't be redeeming. But at the same time, you should probably be raising more capital to buy more right now. But there's an opportunity in crisis where you can create some great value or great buying opportunities. But, as Scott said, and I believe him, capital raising is tough.
When you're out looking to buy more in 24, what is could you describe the asset that would get your attention the most?
Well, look, the two asset classes that we like, our long-term themes are on multifamily and industrial. We like those themes because there's a supply and demand imbalance for the long term, not just the short term. And look, no one can predict what the market's going to do. And so we try to pick asset classes that we like for a long, long time, and then find the right asset and the right node that we like. Like one of the biggest things for us is because we're vertically integrated in property management, we have a lot of data. That data allows us to analyze which nodes are doing better than others, and we're very, very active on that. So the themes are multifamily and industrial. Offices.
Would you dabble into the other ones if the right deal came along? And office law specifically, because of course that's the
look. I think
most difficult one.
Retail is, we dabbled before in retail, and we still have some retail assets, but grocery anchored retail. And offices,
That's tough to find. We've heard.
very, very tough right now.
The good retail.
Yeah.
Yeah, it's very, very
And
tough.
then office, if it was a 13 cap, does that just go, oh, that makes sense? Like,
So the problem on office is not necessarily the cap rate. Like 13 cap is like, sure, that piques our interest, right? It's really that cash flow. Like there's going to be a bifurcation of office from sort of B, C class office into more A class office. And the office is not all the same, right? There's assets are, say, 100% vacant, and there's assets that are 100% full, right? So there's a huge bifurcation of quality of office. Like BC Place, you can't get a space, right? CIBC Square is full, right? So, but there's other offices that are tough. So you really need to understand that cash flow, because even if you say a 13 cap, is that 13 cap going to 2?
yeah, well, exactly.
In 2 months?
We had this conversation yesterday. What
So
are
what does
net
it mean?
effective rents in 2029 on office, right? Like, what does that look like?
In which
Yeah.
building, right?
Yeah.
So a BC Place net effective rents is different than
Yeah.
C class
Suburb.
office building. I'm not sure a 13 cap would be very attractive for that.
Where most of the tenants roll in the next 3 years, and
But if BC Place came out at a 13 cap, yeah,
Yeah.
I think there'd be a lineup of people wanting to buy that, right? So
Pivoting back to office before we finish here, is there a lot of value add opportunity out there still? I mean, we've talked about the institutionalization or the attractiveness of our apartments to institutions. There's a resistance, of course, from CMHC to finance a lot of the repositioning assets. Does that change your perspective? Like, do you look for more of the newer assets that are more stabilized, or are you still kind of looking for the emerald in the rough, so to speak?
I think we're looking at both. Like the newer assets, we did buy some new assets in 2022. 23, we're more building newer assets. And when we say value add or older assets, it's not just about necessarily repositioning them. It's about just improving that asset for the long term.
Yeah.
We're trying to pick assets that we like in good locations and make a better product, make it a better product for tenants and customers.
Well, what
right?
you've done at West Lodge, maybe just point one out. Like, that's an awesome project that you've done, right?
Yeah, West Lodge is, we turned it around.
what's the background on that one? I'm not familiar.
We bought, it was an asset in Parkdale.
Okay.
That,
Huge asset, 1,000 units. Like, it's a massive.
750
Yeah.
units. It's a great asset. Our tenants are great there.
Very poorly run, right? No
It
offense
was-
to the previous owners, but just
Yeah.
wasn't the best.
Wasn't
quality
the best,
asset.
but
Yeah.
it took a lot of work, a lot of building trust with the community that we were good property owners, that we had the best interest to make it a community, and I think we proved that we are there for the long term, and we and tenants and our customers, really more than tenants, have really taken a shine and like what we've done in that property.
Yeah, the
So
communities have kind of embraced you guys now.
we feel so. I hope so. It was a lot of hard work, but yeah, and then I think the team has done a great job at doing that, but it's a lot of work.
Those are the stories that, I mean, you got to get away from this landlord concept, right? That your partners, your community builders, your owners, right? Like it's a totally different vibe than the lord of the land, right?
I think that's the big thing. Like, we are community builders. We want to be in the community. We want to serve, and our tenants are our customers. And if you provide a good product and a good long term, and there will be good things. And housing is tough, but it is trying to build that community for the long term.
We've heard from a few of our guests today that there's a bit of an aversion to buying core assets right now. Agree or disagree with that thesis for 2024? That value adds more the way that everybody's
And let me just,
going.
the context, I think, is just that pricing on those core assets is really difficult. So
versus finance available. Yeah.
What's the definition of a core asset?
Like maximized rents would likely be like
just like a
day
brand new
one cash
apartment,
flow.
brand new
Yeah.
apartment, great location, center ice. You
Yeah,
know,
so-
it's maxed out, $5 rents. You know, it's fully occupied.
So I would agree with that statement then, because if you're buying something that's all the rents are market, your cap rate that you want, there's a huge bid-ask spread. Because everything's at market, so the only thing that you're sort of looking at is how much is the market going to grow, versus buying more of an older building. You're waiting for tenants to move out gradually over time, but you're not really need the market to grow. You just need to be at market. And so, yeah, it's the pricing on a brand new building, the cap rate that a buyer like ourselves will be a lot higher than more of an older asset. And a vendor's not going to want to take our price.
Yeah.
And
yeah,
so
makes sense.
there's a huge bid-ask spread right now.
I'm kind of amazed at how long that bid-ask gap has lasted, because interest rates went up 18 months ago and is still just persistent that
But like I would say the most multifamily owners have little debt and more long-term fixed debt. And so CMHC has been able to stabilize that market because they've been a great partner in providing that long-term financing. And therefore the rate increases have never necessarily affected the majority of multifamily owners. No, some have.
Depends on your maturity risk or your maturity role.
Yeah.
What your maturity profile looks like.
But even the maturity role, right? If you have a CMHC loan coming in due at the wrong time, you're not taking principal risk, you're taking interest rate risk, right? You will roll over that debt because it's CMHC insured. It's not like in the States where you have a worry about paying down that debt, or office, how much debt are you going to be paying down, right?
Yeah.
You're just worried about, okay, now you're 1.8%, now you're 4%.
Yeah, and can you just increase your AM, fortunately, too, right?
But it's a little bit different risk.
Last question. I'm going to let you go, Ugo. Affordability is getting all the headlines and all the attention, but given your scope and size, I'm just curious what your ESG approach is. What do you do? Look at your portfolio. How important is just ensuring you're kind of future-proofing your business to the impacts of climate change?
Yeah. ESG is probably table stakes right now for us. We look at our portfolio very much on the ESG lens. And I think when we talk about ESG, like we're really focused on the S, on the social too, on the affordability, but also on the environment. So it's just not just the E. A lot of times when people talk about ESG, they think about the environment.
Yeah.
And I think I sort of understand that in more different asset classes, but in multifamily, you need to be very, very focused on the S, and on the social and the community service, and what you're providing your tenants and your customers there. Look, we are looking to make sure our buildings, we try to get to that net zero footprint by 2030, right? So, but that's going to be a tough task.
It's a lot of work.
It's a lot of work, and we're not going to be able to do it by ourselves. We need the government to really step up, because even if you wanted to put all electric boilers and all electric cars in your buildings and really have everything that's electric, and we have a good electric grid here, hydro, very efficient, the infrastructure won't hold it. So that needs to change too. Like, hydro won't be able to support all the electric boilers that you need to put in. So there has to be solutions, and everyone has to work together to make that. But it's table stakes. It's everything.
It's on your mind. Clearly.
Table stakes at an institutional level, but we could argue that it's not table stakes for the part of the market, small privates. How long till that part of the market catches up? When does it become like a
we probably need government incentive? I mean,
you can't ignore it.
I think it catches up when a private guy is selling their building, and a guy like
and you're
ourselves,
not there to buy it. Yeah,
a guy like ourselves says, "Yeah, I think it's worth X, but I'm taking Y off because of ESG," and he's going to go, "What?" Yep, and it's going to affect pricing over the long term. It's not affecting pricing today, but I don't know what the impact on pricing is. Like, don't
Yeah, you can't get there yet.
but it will have an impact where institutional buyers like ourselves and our institutions will say, look, we're not buying this building because
It doesn't fit within my ESG strategy. Yeah.
yeah, and also we would need to price it to make it in the ESG strategy. So we have a whole department now focused on ESG. It's everything that it's very, very focused on what we're doing. So if private buyers that don't, private individual owners that don't want to think about it, will be affected over the long term. It's not now, but over the long term.
Instead of deferred capex, it's deferred ESG that has to be built into the pricing.
But it's deferred capex and deferred ESG are almost the same, right?
Yep.
Like what are you doing? Like what are your boilers? What are your windows? What are your installation?
Yeah, I'm buying this thing, but now I got to spend $2 million to fix it up to the quality that I require for my portfolio.
Yeah, but like for example, like new roof. Okay, before it was 100,000, now I need 300,000 because I need to put an environmentally friendly green roof, right? So that's going to be affected. Before you're only factoring 100, now you're going to factor 300. So it will affect pricing for sure.
Ugo, we're out of time. Thanks very much. That flew by. It's love talking about apartments. We could do that all day long. Well, actually, I do that all day long. Thanks to First National for powering the podcast. Thanks to Dow Vukovic, ML Emporio, and Turner and Townsend for sponsoring the speaker video series here on day 2 at the Toronto Real Estate Forum. And of course, thanks to Ugo for taking the time.
Thank you for having me.